Hello, everyone. Today's discussion is going to be a blast. Not only do I get to have a conversation with some of my favorite people in the commercial real estate industry, but we're also going to nerd out about my favorite asset class, which is multifamily. This is Investing in Residential and Multifamily Real Estate, episode 1 of the Financial Poise Real Estate Investing series. You can read more about Financial Poise on slide 42. And our panelists are Tammy Kelly of EQT Exeter, Susan Lawson of Newmark, and Tracy Traeger of Syndicated Equities. And I'm Ingrid Carlino of CIBC. You can see our names on slide 6 and our bios on slides 36 to 39. Neither Financial Poise nor we intend to be an infomercial, so please take a look at those slides if you want to read our bios. Now, about the slides. I will try to call your attention to the slides that are relevant to whatever we're talking about, but you can take notes, but don't worry if you're listening and not watching this, because you'll be fine. The slides are not a critical element of what we're doing. So Financial Poise webinars are sponsored in part by the following: Sunburst Digital, maker of Type to Learn, the #1 typing app for children K through 12. Max X Asset. If you need to conduct an online auction, Max X Access is your turnkey solution. Mood, the nation's premier online retail cannabis dispensary. And then the last thing before we begin is slide 5 contains a disclaimer. You are not our clients. We are not your lawyers. 3 of us on this call aren't even lawyers. But what we do here today is for your general education, and it's not for you to act without appropriate advice. So here we go. Tammy, let's set this stage. Can you tell us a little bit about the different kinds of residential or multifamily properties that someone might invest in?
Yes, I'd be happy to. And hi, everybody. And glad to be here and speaking with my colleagues and peers. So thank you for the opportunity to be a part of this presentation. So different types of multifamily properties are, kind of thinking about classic apartment homes that can be, anywhere from, probably 10 units and up. You can have student housing, built purpose properties that, sound exactly like what they are. They're, located around different universities and educational environments throughout the country, and specifically geared towards housing graduate and undergraduate students. You have senior and assisted living, and a new kind of commercial real estate qualification is single family home rentals that is quickly becoming popular in the commercial multifamily space. Mobile homes. And then again, and of course, on the residential side, you have rental homes, you have co-living apartments, condominiums, and duplexes, which may be an easier way to enter into the multifamily investment space.
Great. So I love the discussion of student housing. I have 2 kids that are in college right now, and I think that is an asset class that has just absolutely exploded in the past few years. I am shocked by the amenities that are offered sometimes at these student housing projects. They seem to look and feel with the amenities of a Class A rental building. So speaking of which, Tracy, we speak sometimes about Class A, B, and C. Why don't you explain what that means?
Sure. So thank you, and hello, everybody, and good to see you all. So Class A, B, and C, I mean, really, you're just trying to sort of categorize a little bit about what kind of a property you're talking about. A Class A is going to be your new construction, high-end product that's well located. Generally, it's going to be well maintained and managed. And when you build something, most developers are building to that sort of high bar standard. You've got a lot of amenities in the unit. You may have natural quartz or granite countertops. You're going to have washer dryers in your units, brand name appliances, things like that. The building itself, depending on what kind of a property you're talking about, may have a lot of amenities. It might have a place to wash and dry your dog, in addition to just letting the dog out. Outdoor grills, patios, kitchens, things like that. Fitness centers, things like that. The units are gonna command the top rent in the market. So that's sort of your high line. Your tenant base tends to be stable, employed with ample savings to cover rent. The sort of lower end of the spectrum is what you call Class C. That's going to be usually older product, older construction. Maybe it's not in the best location. The building and units may not have a modern feel to them. Although there's plenty of well-run Class C buildings, so it doesn't mean it's a hole in the wall. But maybe you have to rent your washer dryer yourself instead of, or go to some common area laundry because it's not built in. Maybe you have to walk up a flight of stairs to your unit because it doesn't have elevator service. The rents, maybe the building needs some deferred maintenance when you buy it. The rents are going to be more affordable. The tenants are more likely to be working class students, perhaps, that don't have a high income, elderly or fixed income folks, maybe folks with lower credit scores. And the B is really somewhere in between. I think of a B as like an A that's maybe 10 or more years old that hasn't been kept up with the times. Maintenance management tends to be good, but not great. Maybe it needs some updating, certainly cosmetic updating. Apartments, for example, that might not have a home office post-COVID. And these kinds of projects actually lend themselves to a great value add to sort of reposition and bring them back up closer to that A standard or what's current in the market.
So I've also heard of people using the term workforce housing. Tracy, how does that fit in?
Sure. I mean, so the workforce housing, I think is in many instances, it depends on what you're talking about. A lot of people use that as a nicer term than affordable, because affordable has some connotations that workforce, at least it sounds like it's a person that's employed. But it's going to be apartments that are more affordable, that basically if you think about like a Starbucks, I'm always thinking about Starbucks. If you think about Starbucks, the barista that makes your coffee might live in workforce housing, and the manager that runs the Starbucks might be in the Class B housing, and the person that actually owns the physical building, the physical Starbucks building, maybe is in the Class A housing.
Got it. So it has more to do with the affordability of the unit, whereas the ABC sometimes has more to do with the amenities and kind of quality of the building, even though those two kind of work hand in hand. Huh?
The quality of the building and the financial wherewithal of the tenant base.
Got it. Great.
And
all right.
Sorry,
go ahead.
And I think of classes A, B, and C. I do think of it a lot of times by age and physical obsolescence. Tracy mentioned in Class C's, you may not have washers and dryers, but that's because the property wasn't built with that capability. There's not the plumbing underneath the building to even support it, and it's very expensive to bring those kind of facilities to older properties. So I think that also has, in my mind, a connotation with how classes rank.
Yep, great. So Susan, let's say I found this building and I'm trying to figure out, is it a good investment? What are some things that I should be thinking about?
Well, when you look at the various criteria, right? There's multiple factors buyers consider when evaluating the investments. And they are, outlined, many of them are outlined here: location, amenities, competition, who is the property I'm looking at right now, are our rents below the competition, in which case I have an opportunity to increase my rents to be more competitive. And then the overall market conditions, Tracy talks about Starbucks. A lot of investors are looking for certain big box retail, Starbucks, Whole Foods. But the one thing you have to keep in mind is, while there are these, factors to be considered, there is a subset of buyers who will have a different acquisition criteria than another subset. So we talked about class A, B, and C, depending on the fund or, just the capital that investors want to outlay, depending on what bucket those fall in. You might have a fund that is only geared towards core and needs a core return. And we'll talk later about returns. Or you might have investors that are looking at, kind of value add, which is, we talked about the B assets, great location, might have a little obsolescence, but they're older. They have Formica countertops versus quartz that Tracy talked about. So each investor has one or multiple buckets of capital that they want to outlay. I, as a broker, have sold A, B, and C. I just sold a property, and it was very much a C property, but there was very much an interested buying pool for that. Meanwhile, I'm selling a core asset, and those are different buyers. So you have a subset of competition when you're looking at an investment opportunity.
Yeah, definitely. And I know the one thing, as the friendly banker on the phone, we're going to be highly sensitive to what is the cash flow? What is it today? And what is the future cash flow going to be on that property? And one way that I always like to look is, how are the surrounding properties doing? And that can work for or against you, because the reality is you want to make sure that there is at least something else in the nearby area that might be doing what you think this building can or will do. It becomes really challenging. I think it's kind of fun as an underwriter, but when someone is maybe constructing the highest end project in a particular location, it will be the top of the line. It's difficult, though, to kind of know, is it if you build it, they will come? Or is this a market that is not going to generate the sort of revenue that you would expect from the building you're going to build? So from the banking side, we have a tendency to be a little bit probably more conservative. We're going to take that more conservative eye. But as an investor, it's definitely something to consider as well.
Well, and also, too, I mean, in today's market, given last year's volatility in the debt market, and while today it's stable, it's still fragile. Investors are very much tied to the amount of debt that you're willing to provide, right? So You're absolutely right. They're looking at the demographics, they're looking at a number of different factors in the area to determine whether they can raise those rents. You talk about a class A versus, now I'm looking at a class B. We call those class A's inspirational competitors, right? Maybe if I renovate my unit, maybe I won't get as high of a rent as the class A, but I am going to be able to close the gap and still be a better value alternative.
Right. So Tracy, I was touching a little bit on new construction. What are the risks and benefits of investing in a new development versus an existing multifamily investment?
Sure. I like to think of this as, how much adventure do you like? Or what kind of, choose your own adventure, remember those books. But so when you're investing in an existing structure, maybe you've got, certainly the building is built, you may have your apartment's leased, maybe it's fully leased, maybe it's mostly leased, maybe you are trying to, but you've got already some tenants in place. And depending on the condition of the units, you might be able to, as soon as you invest, you close on your acquisition, you can start enjoying cash flow right away. And maybe you have a strategy to improve this, that, or the other thing, or maybe you don't, but your property is your profitability is going to depend on what you start off with. And then you can go up or down from there. You've got a benchmark. You have something called a trailing 12. You can see how this property has performed over the past year to give you an idea of what to expect and what kind of cash flow you're going to have. Development has its own set of risks. So you start off, keep in mind that when you start, you have no cash flow because you cannot get tenant rent from a hole in the ground. You've got to get permits. You're going to have a construction budget. You're going to have to worry about whether your labor and supplies show up on time when they're supposed to go, that it's not going to be your weather conditions are going to be such that you can actually build on that schedule. And then you've got to get the building built, and then you've got to get it leased up. And depending on how long that construction takes, the market can sometimes change substantially from the time that you start until you're actually have a building ready to lease. There can be new competition that comes online. There can be some sort of change or government regulation changes that make people not want to be in this location, or some road construction thing. I'm right off a highway. Well, guess what? The highway is shut down for the next 3 years due to construction. That's going to impact you. So, and you're going to require upfront capital to build it, because remember, there's no cash flow. You, Ingrid, are not going to have any cash flow for your loan. You're not going to give it's a different kind of a loan, a construction loan, to build something when there's no cash flow to pay it off, as opposed to something existing and maybe stabilized, maybe not, but at least you've got tenants and you have some income to offset.
Right. And then, Susan, let's talk a little bit about value add. That's a little bit of a type that occurs between those two. So what types of things are currently being done in today's market to add value to multifamily assets? What are you seeing?
Sure, absolutely. It's really, really interesting. I talk about those buckets of capital, right? Whether you have a fund or whether you have a separate account or a private investor. But what Tracy just talked about was an opportunistic fund where they need a higher rate of return, right? And so in the value add space, in a new development, your internal rate of return is 20 plus. In the value add space, you're kind of in the mid-teens, right? And the way that you're going to be able to get those returns is by increasing rents. And so when a value add buyer looks at an asset, they ask themselves, what can I add to the property, both in the unit and then amenity wise, that will allow us to push our rents. Having said that, I would say kind of the newest trend is, you've got bocce ball, you've got, I forgot the name, not a tennis. What's the other one, Tammy?
Pickleball, yeah.
Pickleball. Sorry, I'm a tennis player. I have yet to convert. So pickleball, I've seen that where if you have tennis courts that haven't been used, all of a sudden they're being used. Tracy talked about it, anything dog related. It's a dog park, it's dog agility, it's dog, walking, it's, just different amenities and services. Very often what I find somewhat amazing is that, I like right now I'm selling a multifamily property that I actually at one point sold for Tammy, and that buyer redid all of the amenities, even though Tammy's organization had done it. We're selling it again, and the current buyer is updating the amenities again. So sometimes, again, buyers have different visions. So, so really you're looking for a club room in addition to, you know, various sports, you're also activating space. Maybe it's a large property and there's some open, you know, kind of grassy knoll that you can put a fire pit in with seating. And a lot of times, maybe no one ever uses that, but it is an attraction to those that you're leasing to. And again, someone's envisioning, okay, I can live here. I love that. I'm going to sit here and read my book and, you know, light the fire outside. And it's just ways in which to, again, increase the rents. Then going into the units, you're absolutely hard surface, unless it's a market that doesn't cater to that. To your point earlier, Ingrid, you have to really understand your competition and where you can take the value. But a lot of times it's, you know, hard surfaces, faux hardwood flooring throughout the property. If, you know, noise proofing allows, you know, it's closet organizers, it's new cabinetry, definitely stainless steel. So, you know, it's really the modernization of the kitchens and baths, flooring, and then closet organizers that tend to be very, very important. Washers and dryers, to Tammy's point earlier, if there is a capability of putting washers and dryers, typically they're stackables, you know, then putting that in is absolutely going to create value.
Yeah, I've also seen an increase, you know, sometimes in the older buildings, they weren't designed for Amazon deliveries. And so people have had to eat into what used to be somewhat useful space for just the volume of packages that sometimes will run through, whether it be student housing, multifamily rental and whatnot. So our lifestyle just continues to change and evolve.
Well, and it's interesting, it's not just space, but if you don't have, you know, a set Amazon system or, you know, a very large storage area with a good system, it also absorbs a lot of your, you know, your staff, and it can be very time consuming and therefore expensive to manage kind of the evolving consumer.
Yeah.
Well, and this is where I feel like it does make a difference, you know, who is your tenant and what will they pay for? There have been properties where we've actually rented out to Amazon, let them put an Amazon locker at the property someplace, like in the laundry room or something like that, and people can go. Other clients where we have more exclusive clientele in a Class A apartment, we actually will deliver. We have a human being that will go and put the package literally in front of your door. So it depends on what kind of a property, what kind of space you have, and what people will pay for.
Yeah, agreed. And just to really quickly add on to some value add opportunity that you've seen, that certainly some shifts in trends and really driven by consumer and the demographic desires, needs, and wants. And perhaps some of these students coming out of these fabulous, you know, student housing facilities to like now renting in the more traditional sense is smart home technology. And that can be defined various different ways, whether it's, and some of this is also, you know, ESG initiatives too. You can do everything from smart thermostats, you can do to smart locks, lighting, you know, you can kind of do everything in between. And then also, you know, like electric car charging stations on your property, which is again becoming more and more not only a trend, but a true need. So those types of opportunities also exist when you think of value add. And again, it's to Susan's point, it's you're looking at the dollars that you're going to invest as an owner and comparing that to how much, based on the submarket and the demographics and the in-place rent roll, you can increase your rents on top of that, and you're backing into a return on investment for those dollars that you're putting out, you know, initially to invest.
Exactly.
Right. And you know, the last thing I want to mention about the value add is that and Tammy touched on it a little bit with some of the management-y kinds of things. is that having good responsive property management, whether that's having a technological solution like an app so that if your dishwasher breaks, you can send a note in the app and somebody will come out, management will know, or just having like a person there at a desk that you know that you can go talk to and get help. I can tell you, we've had a number of projects that we've done where we bought a property and somebody would have something break in their unit, and it would take way too long, in the tenant's opinion, to get somebody to respond and fix it. And just being responsive and having somebody available right away, and being a responsive management person to problems, questions, concerns, etc., is another form of value add that doesn't necessarily physically require you to do something to the property.
Yeah. So actually, let's touch on that. So Tammy, what is the difference between property management and asset management?
The way I think about the difference between the two is from property management, this is really your team that is tackling those day-to-day resident interactions, whether it is a prospect walking into your building and wanting to lease a space, to an existing resident that already leases space in your building and needs a work order completed, or needs to renew their lease, or has a question about something on the property. So your property management team encompasses all of those things. You may have, depending on the size of your property, a team on site on your property managing those day-to-day interactions. You may have regional teams, so forth and so on, but then there's a lot of support behind those teams if they're located on your site or regionally to help, again, support all of the things that come up with resident needs: collecting rent, billing, marketing, maintenance, snow removal, all anything you can think of with regards to just managing your day-to-day on your property and keeping it in a safe safe and maintained condition. With regards to asset management, I really think of that about those folks taking a step back from the day-to-day and thinking about strategy, and how, as with strategy, how am I going to make my investors money, and how am I thinking about things to ensure that the dollars that we're spending are getting our investors that return on their investment? How are we positioning the property in the market that is going to allow us to get the difference in the rents? Or vice versa, thinking about strategy is when you do see market changes and shifts, that you're proactively thinking about, okay, we're seeing a shift. What do we need to do differently to ensure that we're changing with the times? And so I think the simplest way to think about it is property management is really day to day, and it is a lot to do on a day-to-day basis. Asset management is really thinking about strategy and portfolio kind of metrics and conversations and investor relations and returns. That's
Got it. Yeah. And so, Susan, if this is someone who's just thinking about getting into maybe their first property and they're like, I don't know if I want to hire a property manager for a single property, what are some things they should be asking themselves and thinking about? And by the way, we're on slide 29, which talks a little bit about this.
It's interesting. I think the big thing is, do I have the economies of scale, to really manage it efficiently? In other words, do I have, there's so much that goes into it. Do I have contracts with, internet providers or various tools and, internet tools that you need in order to run the property, like a real page? Do I have, do I want to set my market rents, or do I want what's called, it's essentially daily pricing like the airlines, so you have to think about, what do I need in order to run a property effectively? And do I have the economies of scale to really leverage it, or should I use a property management firm who has a much larger portfolio than I do, considering I'm starting new, and therefore they can, really be much more efficient in the spending. I think the other thing too is, do I have the time to manage this on my own? To Tammy's point, and to Tracy's earlier, you really have to identify top talent at the property for the property to succeed. And if I have turnover, or if I don't have, ample benefits because I'm just starting out, am I going to attract that top talent? So I think it has to do with economies of scale and, the efficiencies. And also too, do I really understand this market? This is the first time I'm here, but if I hire someone who maybe manages properties within the region or within the specific market, they're going to understand pricing. They're going to understand the resident base. They're going to understand the drivers that bring in, the potential renters.
And also sort of where you are physically in relation to the property. A lot of people get started, they'll buy, they may get started by buying a 3 flat, and they live in one and the other 2 are upstairs or downstairs for them. Okay, that's pretty convenient. And maybe if you're around and you have know how to fix a leaky faucet, you can deal with that yourself because you're right there. If you're investing in a property that's in another city or state, there's no way that if you've got the same leaky faucet, you've got to now call somebody and get somebody to go over there, because you're not going to hop on a plane and go fix it. By the time you get there, your tenant is already, going to have escalated the problem. And it's, you can't do that remotely. So I think that's proximity and your expertise in things also bears relation. In addition, Susan is exactly right with economies of scale and how many units are you talking about, and what makes sense.
So Tracy, I love the fact that you touched on proximity, because one of the things that seems to be available today is we can view a property on a website. We can see drone footage of it. Tammy, why don't you tell me why it's still important to have boots on the ground before you go and buy a building?
Yeah, so I think that is extremely important because you need, as an investor, you want to physically walk that property. You want to, because photography, there's people that make a living at this, and they have maybe some tricks of the eye, lighting, positioning, so forth and so on. But you really need to walk that property. And one of the most important takeaways is surround yourself with experts in various disciplines for due diligence, which we'll talk about in a moment. But walk the property, get on site, get a feel for the layout of the property. You'll get a feel for the resident profile. You'll see the different cars in the parking lots. Maybe post COVID, it is maybe a little bit different of a feel. But is your parking lot full at 10 a.m. Or is it, are people leaving for work around 9 to 10 a.m.? What kind of cars do you have in the parking lot? When you walk vacant units, what kind of condition are they in? Are you getting them back that's going to be an easy turn? Or are you going to have to spend thousands of dollars just to turn a unit to make it leasable again? Those are all things that you won't be able to see from a website. And those are things that are going to be really important evaluations in your diligence and understanding what your true needs are and what your cash outlets will be after you close.
Yep, definitely. And I will share a little story, because as bankers, we often will go out on a regular basis, especially for larger assets, and conduct site inspections. And I will tell you that some of the most challenging situations that I've come up with are actually during a site tour. So I had one where a brand new building was built. It was like 187 units, 55 plus rental building. And I don't know the first thing about architecture, but as we were walking through, I had asked the building engineer, I'm like, so, is there anything that's kind of in disrepair that you guys are still working on, because with new construction, there can be issues. And he goes, oh, do you want to see the mold? Yes, I think it's important that we see the mold and what was happening on this building. And you would think there were tons of experts that were part of this large development. The way that the what is it? Not a patio. The balconies were on each of the buildings. I don't remember if it was exactly flat or if they actually tilted into the building a little bit, but every time it rained, water was going into the unit, and every unit had a little bit of mold right along that growth line. They had to take all of the balconies off, the entire skin of the building, and rebuild them. So that's something that would not have come up. The lender wouldn't have known until we actually went out and saw it. So there are a lot of things that you can uncover during actually going on the site tour yourself.
And people will talk to you, whether it's
people will talk to you,
whether it's the maintenance folks, the office folks, or your residents.
Yep.
They're happy to chat, and you find out a lot of information.
Many elevator rides have been very enlightening. That is true. So location, right? We're talking about real estate. So Susan, why don't you tell us a little bit about what are the hot markets today? And I'm going to move to slide 32, where we've got some actual data. Slides 31, 32, and 33 have some great data points on them.
Yeah. So it's interesting, right? Because, when
Susan, your camera has moved.
Oh, I'm so sorry.
That's okay.
So when you think about, the hot markets, right? I mean, all of us in the real estate environment have heard about Nashville, have heard about, Austin, have heard about so many different coastal markets, right? Well, what happened in those markets is that because they were hot, and why are they hot? Job growth, new infrastructure. People are just migrating, whether it's after school, college graduates are migrating to these locations. And again, it's various Texas market, Atlanta, the Carolinas, Florida, Nashville, Columbus, all very, very hot markets. But as you can see from this slide, not only are the, potential residents migrating there, but so are the developers. So now, fast forward 3, 4, 5, 6 years later, we now have an oversupply in areas like Phoenix, Austin, whereas in Chicago, we have a very, very balanced and actually a need for more multifamily housing. Well, what does that need do? It provides pressure on the rents. And so when you think about hot markets, you're balancing between where is the job growth, where is the migration, but also where is, a good supply story. And then Ingrid, if you go to the next slide, what you'll find is because of this balance of supply story, you want to look at where is the rent growth projection. I mean, to your right, you have markets that are going to have negative rent growth because they're battling this oversupply and there's not enough people moving into them. So you're not absorbing those units. And therefore people, owners are kind of fighting for that resident base. Whereas in San Jose, Chicago, and the other markets to the left, because of that supply constraint, there's a projection that, rents are going to be higher in those markets this year. And that is absolutely something that investors look at.
Yeah. Tammy,
And-
touching on that, there is always this battle on multifamily buildings of, do you hold out for higher rents or do you fill the building? What are your thoughts about occupancy versus rent growth?
It's a really good question, and one that as an investor you should be asking yourself on a regular basis. I think so. The answer to that, it really depends on your strategy. It really depends on where you are in the hold. It somewhat depends on your debt and the cash that you need to get, out of the property, or if it's like a break even. So a couple things just to keep in mind. As an investor, you want to see rent growth. Growing your rent is how you're going to grow your valuation and how you're going to grow your returns on your overall property, right? When you go to sell it, you are not going to save your way to success by just, cutting all expenses. You need to focus on expense management, but you really want to, again, for valuation growth, you want to grow that rent. You can, and it's a balance between being at a stabilized occupancy and pushing rents along the way. And it truly is a balancing act. You can say that in a time of inflation in which we've been in over the last, debatable 12 months or so, that occupancy is a better play because your rent growth opportunities are slowing. So it's an ongoing conversation that it's not a one size fits all. It needs to be matched very specifically with what's happening in your market, what's happening with your demographics, what's your investment strategy, and what's your need for a returns perspective. And again, depending on your debt, there might be some very specific considerations that you need to be thoughtful about as you're making those decisions as an investor.
All right, so let's move on to talk about money. Tracy,
Ah,
I'm going to take everyone to slides 21 and 22, but why don't you tell us a little bit about, most people when they're buying their home, they're going to take out a mortgage loan. Is that typically the case for investment properties as well? And what are the advantages and disadvantages of taking on debt?
well, it is more typical than not to use some sort of leverage when you're buying an investment property, but only if it makes economic sense. Okay. And I think this is where you need to take a step back right now. We're in an environment where interest rates are on the higher side, at least as compared to recent past. And ideally, you want to be able to borrow at a lower interest rate than what the cash flow is you're going to generate for your investment. So if you are paying Ingrid 6% on the loan from Ingrid to buy this piece of property, but the cash flow that you're going to get from this property is only 4%. Well, now I'm actually making Ingrid a lot of money, but I'm not making myself a lot of money. So you ideally want the point of using leverage is to make money off the borrowed money so that I'm borrowing from Ingrid at 4%, but I'm getting 6 on the money that on the cash flow. So now I've got sort of a 2% gap. I'm making money on the money I have borrowed from Ingrid. That's what you're trying to do. Recently, I've seen a lot more real estate transactions, particularly from individual investors who are buying either individual units or smaller scale investments that are going ahead and buying those with no financing because the financing doesn't make sense. You can always take a loan later. So it really, I think it sort of depends. Now, I will say with respect to multifamily, there are some lenders out there, Fannie Mae, Freddie Mac, HUD, that are available for multifamily properties that are not available for other kinds of commercial properties. So back to the, you know, the Starbucks that I keep talking about, you might be able to get a better loan for a multifamily property than something else. But ideally, you have to look at what the loan costs you versus what you can make from it.
Yep, absolutely. And I know we were having a conversation before the cameras started rolling regarding what are lenders looking for today. And I will tell you that that is not an easy question. It's not like a straightforward mortgage loan on a home. There are lots of different levers that you can talk about with your banker regarding your specific asset. And so things like recourse, which means, is there a guarantee that you personally are willing to put up in case the cash flow does fall below a break-even point? That can be done. Also, we've seen guarantees that are to funds or to other different vehicles. You can get real fancy with recourse, but most banks these days would be looking for some level of recourse on any commercial property. And there are another thing to touch on would be the concept of debt service coverage. And so that essentially is when we're talking about, is there enough revenue being generated by the property on an ongoing basis to cover the amount of the loan note on any given month? And your lender is not going to want it to always be 1-to-1. Like you said, Tracy, they're going to want there to be a little bit of a buffer in there. And that has really, in today's market with interest rates where they're at, been the factor that is kind of deciding the amount of that loan. Sometimes when rates were really low, people were talking more about a ratio called loan to value. And that is, what is the value of the asset versus the amount of the loan that you're taking out as a whole. And there were times where that was the deciding factor. But in the environment that we're in today, we're seeing more the cash flow from the building has to support the amount of the payment plus a little bit.
And with respect to that loan to value ratio, I will tell you that traditionally we have seen much higher loan to value, 70%, 75% generally. It traditionally has not been a particularly high loan to value for a multifamily project. We are seeing, because of the other tests that are being used, that right now a lot of multifamily projects are coming in at like 40% loan to value, a lot lower,
Yes.
lower.
Agreed. And in the really large lending spaces, so when we're talking about these large multifamily buildings, one other thing worth noting is that while it's an asset class that's still very much in favor and that lenders do like lending on multifamily, some of them have done so much multifamily lending that the regulators are like, hold the phone, you need some diversity in your portfolio. So keep in mind, too, your friendly lender may want to give you the loan, but has so much currently in their portfolio, they just can't fit yet another one in. So that's another bizarre challenge that's going on in the market today. But Tracy, let's talk a little bit, touch on, we mentioned here with the financing, there are some government incentives that are available to a multifamily investment as well. Can you touch on a couple of those?
Sure. Now the government incentives that are available, there's federal incentives, there's local incentives, there's neighborhood, there's a whole laundry list of types of things. Many of them, things like opportunity zones, are determined at a state level, and they're going to have a lot of requirements for your investment structure to set that up. They're going to have requirements about hold period. What you tend to see more, particularly for folks that are getting started, are things like a TIF, a tax incentive financing, or local incentives that are available because the community wants economic development in the community. And it's sort of a push, pull, give, take, and that the requirements are going to depend on where you are and what you are. But it may say, okay, if you build this Class A apartment and you have X amount of affordable units, or if you build in this location that's closer to our public transit that we're trying to increase ridership on, we're going to give you a break on your real estate taxes, maybe indefinitely or maybe for a period of time, in exchange for the economic development that municipality or locality is trying to promote. And it's very, very, very location specific. Most of it is in the form of credit against the real estate tax. There are some larger scale federal incentives like LIHTC, that's really more suited to an institutional investor, where like your bank may be, CIBC may be investing because they need to use dollars for the greater good in something that is developing a product for folks that are maybe below a median income level, for example.
Yeah.
But for most folks, it's the local incentives, and they vary very specifically by where you are.
Yeah. And for those listening, number 4 in this series, we're going to be talking about affordable housing as the topic. And this will come up in a much more robust fashion as we talk about how investors are even getting affordable housing deals done in today's market, because these government incentives are such a key piece to that. So we're thinking about buying a property. Now we're trying to decide, are we investing with a partner? Or are we doing this on our own? Susan, what are some things we need to think about if we're thinking about investing with a partner?
You know, it's so interesting. So my role as a multifamily broker is to sell properties, right? So I'm trying to find the best buyer for a particular asset who's going to, you know, close on the transaction at the price that they went under contract. Investing with bringing two partners together is like a marriage. I mean, in addition to really determining kind of rights and structure, who has control over the day-to-day activity, who has control over, the value add and the construction that's going to take place. You really have to be married to the same strategy and also the same returns. In addition, how does your general partner, the sponsor, the group, like Tammy in the past has been a general partner looking for, an LP, limited partner, to come in, right? And so what type of distributions is she going to get if she meets certain hurdles, if she hits a certain rental rate, if she hits a certain net operating income? So, you have to come to all of those terms, and you have to be really on the same page about the particular asset in order for basically, that marriage or that partnership to work. Typically in your partnership agreements, you do have certain provisions that will say, if you're at an impasse and you don't agree, or there are certain elements that have arisen, when we had COVID, no one expected, some of the downfall that we were going to have. We didn't expect the virus to come, right? So your performance of the asset, was on a maybe a downward trend for a month, 2 months, a year, depending on your property. And so is your limited partner now frustrated because you're not hitting those thresholds? Well, there are typically provisions within the partnership that allow you to dissolve the partnership. Not an easy thing to do if a group is self-managing versus having a third-party manager. Maybe the GP and LP still stay together, but they now have a different management group. So there's so many elements that you really, really have to think about. And one of the things that we've seen is that certain GP sponsors, general partner sponsors, might continue to work with the same LP, the same limited partner, because you've already gotten one, a good relationship, you've gotten those documents solid, you know how the other ones operate. And so it makes it easier to work with someone you already know that the marriage is going to work.
Yep, that's good. And Tammy, I know we're cutting it close on time. So I want to go through the discussion of some critical due diligence items, because these are also things that may come up as key contract type provisions as well for buyers and sellers. So tell us a little bit about what are some of the critical due diligence items?
Yeah, happy to. And I would stress that the most important critical due diligence item is establishing a really solid team of experts in their specific disciplines. So what that means is you're going to have a physical due diligence where you and other professionals are on that property, walking units, walking the property, walking the roofs, looking at mechanicals, and you're walking every single unit to understand exactly what you're buying and what opportunities not only exist, but what opportunities, what deferred maintenance needs to get resolved. In addition, you need environmental experts to go out there and do a site assessment of environmental risk. You'll need that for not only you, but your lender will need that. You need a third-party property condition report. And again, these are reports and or consultants that you will third-party work with to help you evaluate what exactly you're buying, so you theoretically can understand all of the risk associated with it and also the opportunity associated with your buy. You need title and survey. You're going to work with professionals in those realms of expertise to put together what you'll need to close on the property with regards to clean title and survey. From a financial due diligence, you'll have to look at rut rolls. You want to look at operating statements. You want to look at real estate taxes, and you want to consult with somebody in your local market or nationally, as long as they have local presence, to understand how the tax assessor is going to value or evaluate that transaction. Are you going to get assessed differently because you just purchased this property? When are taxes assessed? So forth and so on. From a financial perspective too, you're looking at the operational contracts and making sure that you have those dollars, those expenses put into your operating budget, so you understand again what your cash flow is going to be. There's zoning considerations that kind of fit into that title and survey, and then the building systems we kind of talked about. But again, gather a team of experts. If you don't have that team, network to find it. You can network and you can find experts through NAA, which is National Apartments Association, NMHC, National Multi-Housing Conference. I throw out CREW, which is a commercial real estate organization that there's multiple different organizations and networking that will allow you to make those relationships. Your mortgage broker is going to have recommendations and perhaps direct third parties that you need to consult with on any of your third party reports. The broker selling the deal will have amazing relationships and are going to help you find those connections if in fact you need it. And your real estate attorney is also going to have those networking opportunities. But I would just, have a bench, have a network, work with people that are experts in their discipline. And as a team, you'll get through due diligence and have a good outcome of understanding exactly what you're buying and exactly what the opportunity is.
Great. Wonderful. So I think we've heard some common themes. I'm going to do a little bit of a fire round here to wrap things up. So Tracy, What's one kernel of wisdom about multifamily investing that you wish that you had known when you were first starting out?
I think the most important things are really to start with what you know. Start with have, as Tammy was saying, a bench of professionals that you can call upon. Get everything in writing, especially if you're working with people that you know, so that you can preserve your friendships and your family relationships and not have to hide at the Thanksgiving dinner table. And make sure that you've got sufficient reserves, because if you watch HGTV a lot, which I love to watch, and you see that always there's some, they find some, oh my gosh, there's mold, like what you were talking about, Ingrid. You've got to, you never know what's going to happen. So be sure you've got some funds set aside to solve the problem that you didn't anticipate. So that was lots
Great.
of kernels.
That's
Having
good.
popcorn, but sorry.
Susan, what's a kernel?
I just think that the market is always changing, right? I never, looked on a daily basis where the treasuries were. I think the newest thing today is really understanding the insurance market, right? Could be a whole nother topic. So I really think in order, to be successful as an investor, as a broker, and any third party that's helping, is just really understanding the market and what are the dynamics that could really change your performance, whether it's increase in insurance taxes or other, municipal, maybe their rent control. So just really having a pulse on the market. And, I'd like to believe I'm always 5 steps ahead, kind of understanding how is this transaction going to really get completed.
Great. Tammy?
I would say if it doesn't make sense, ask questions. I mean, there's a lot of common sense, I think, in what we're doing, and that would, it's a little kernel.
I agree. And I will end with the kernel of wisdom that I would give is, if you are having issues in any way, shape, or form with your debt, call your banker, let them know. They can do a lot more to help you along the way if they know early rather than later. So keep those lines of communication open. Great. I want to thank everyone for joining us. And this concludes our program today.